Hey guys, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. Okay, so what we have been discussing about in the last lecture, we have been discussing about the monetary policy instruments, that is the various instruments which are available with the central bank uh, for the control of the money supply and ultimately the control of the money demand, right? That is the main purpose of all the monetary policies, right? So we studied that there are basically two types of instruments which are available. One is the direct instrument, another one is the indirect instrument. So we have covered three direct instruments, CRR, SLR and the selective credit control, and we covered the three indirect instruments in the last lecture, that is repo rate, reverse repo rate and the open market operations. Okay, so now we are going to continue with the indirect instruments, that is the LAF, MSF, MSS and the bank rate, right? So I hope all of you must be having the books to read from there, right? I'm making just the short notes and the explanation to you. After that, you have to read in detail from the books that what is given here and how it is to be written in the examination, that is given in the books. You have to read it from there, right? Okay, so let's start with this. Indirect instruments, repo rate, reverse repo rate, open market operations. These things we have covered in the last lecture, right? So now the fourth part that we are going to discuss in the indirect instruments is the liquidity adjustment facility. It is liquidity adjustment facility. Sir, what it is? Let's try to understand what is it, right? The liquidity adjustment facility. Now it says in case the commercial banks. Now which banks we are talking about? We are not talking about the central bank. We say in case the commercial banks want to adjust their liquidity. Adjust their liquidity means that if they are shortage on the funds, they want more liquidity. If they have excess funds, how they can keep their excess funds so that they reduce their liquidity, right? So we say when the commercial banks want to adjust liquidity. So what are the two situations in which they will need to adjust? When either they have the shortage of the funds or they have excess of funds. So adjustment of liquidity can be divided into two parts. One is shortage of funds. One is shortage of funds and another one is excess funds. So how can they adjust their liquidity in order to control the money supply also, right? So in case they have the shortage of funds, what they can do is, sir, they have an option. What is the option that is available to them? The central bank says nothing to worry as such. We are there to be helping out with you, right? In case you have the shortage of funds, we are sitting, we are there, nothing to worry as such, right? So they say borrow money in case of shortage of funds, borrow money from RBI or the central bank. RBI or the central bank by keeping, but you have to keep something as a collateral, right? By keeping government securities, as collateral, whether these are central government securities or the state government securities, but you will have to keep it as collateral, right? And in case you have excess funds, then what you can do? Then you can park excess funds. With RBI or the central bank, as we call it. Clear? So this is how they adjust their liquidity in case of shortage of funds. They can borrow money from the RBI or the central bank, right? And keep the government securities as the collateral. And if they have excess funds, then they can park their excess funds with the RBI. Now, can you tell me, now if they borrow money from the central bank, will central bank charge any interest from them? Yes, sir. Obviously. What is the interest rate that is being charged by the central bank when they are giving the loan to the commercial banks? We studied about it. What is repo rate? The SBI says shortage of funds, I need more money. The RBI says, okay, I'll give loan, but I will charge the rate of interest. The same thing is going to happen here, sir, in case you have the shortage of funds, you borrow money from the RBI by keeping the government securities as the collateral, this will be at repo rate, right? The bank will have to pay, the commercial bank will have to pay the repo rate, and the reverse is true here. Here they will have to pay the reverse repo rate. Reverse repo rate. Clear? So this is all about the liquidity adjustment facility. You can read from the books. All of you are having the books, right? You can read it from there easily. I have given it in the pointer form in a very simplified way, that how this LAF is working and all other things we have given in the book in a simplified form, but in the form that how the language is to be written in the examination, that is what is very important from the examination point of view, and that is how we have given it in the books, right? Here what I am telling you is I'm making the short notes, crux notes, and telling you the what is the concept behind it, so that when you read from the books, it is easy for you people to understand what is given here, right? So the next one is, the fifth one is marginal standing facility. The next one that is given is marginal standing facility. Now, what is this marginal standing facility? We call it as MSF. What is this marginal standing facility? Sir, what happened? The commercial bank goes to the RBI. He says, RBI, I'm suddenly on the shortage of funds. I didn't check it earlier, but now I am on the shortage of funds. What should I do? I need money to borrow, right? So this is what is emergency borrowing. We call it as emergency borrowing by the commercial banks from the Central Bank of India, right? So this is what is known as marginal standing facility, that is emergency borrowing. What it is? The emergency borrowing by the commercial banks, from central bank, right? Emergency borrowing by the commercial banks from central bank. This is known as the marginal standing facility. Now, you will say that, sir, if they are borrowing from the central bank, they will have to pay the repo rate, right? That's what we have studied, that if the commercial banks are borrowing from the central bank, they will have to pay the repo rate. But in this case, the RBI says, the central bank says that because it is your negligence that you didn't keep your liquidity into check, and now in the case of emergency you are coming to me, I will charge penalty from you. What is the penalty? Penalty will be a rate which is higher than the repo rate, right? So the RBI says, the central bank says that because it is your negligence that you didn't check your liquidity in time, and now in emergency you are arranging for the funds, that's very bad on your part, on the part of the banking system. It's a bad example. Now I'll charge a penalty from you. The penalty will be that the rate which you have to give, the rate of interest, will be higher than the repo rate. Otherwise the repo rate is being charged, but now he says I will charge a rate which is higher than the repo rate. Clear? So this MSF rate is higher than, MSF rate is higher than repo rate, is higher than, right? So MSF rate is a sort of penalty rate. MSF rate is a kind of penalty rate. Clear? Is a kind of penalty rate. Any doubts in this thing? I hope this is clear. So this was the marginal standing facility. Now the next one that we are going to do is the sixth one, that is market stabilization scheme. Now this is what market stabilization market stabilization scheme. Now what is this market stabilization scheme, sir? The first thing, this came into force in 2004, right, as a part of MOU between RBI and central government. RBI and central government. Now, what was the scheme? What was the aim of this scheme? The market stabilization scheme was introduced with the aim of withdrawing excess liquidity, or money supply from the market. That means this scheme is useful when you want to reduce the money supply, right? In the market, when you want to reduce the money supply, when you want to reduce the money that is available with the people in hand, right? And you want to withdraw the excess liquidity. So at that time, this scheme is useful. This scheme was introduced in 2004 as a part of MOU between the RBI and the central government. Now, what is done in this scheme? What is being done in this scheme? RBI buys securities from central government. Now RBI says, I am going to buy these securities from the central government. Now what RBI is going to do with these securities which it has purchased? Sir, the RBI will sell these securities. RBI will sell these securities in open market. Right, to draw out the excess liquidity. What RBI will do is, RBI is buying the securities from the central government and selling those securities in the open market, so that people buy securities and park their funds with the RBI to withdraw the excess liquidity from the market. Right? So this is what is the market stabilization scheme, that when the market is not stable, when there is too much money supply in the economy, when the inflation is there, so what the RBI will do? RBI has a memorandum of understanding with the central government. They say, we will buy the central government securities, right, and sell those securities in the open market. We'll buy the central government securities and sell those securities in the open market. Clear? To draw out the excess liquidity from the market, sir. Right? So this was the market stabilization scheme, right? So marginal standing facility, we have already discussed about it. You can read it from the book. Market stabilization scheme is there. Now the last one is the bank rate. What is bank rate, sir? It is actually redundant these days. In practicality, the bank rate is not used. The bank says that you have a bill of exchange. Right? Let's say you have a bill of exchange, you go to the bank says, okay, I will discount your bill of exchange today. Right? I will discount your and pay you money at the bank rate. Right? It is defined at the standard rate at which the RBI is prepared to buy or rediscount the bills of exchange or other commercial paper eligible for purchase under the Act, right? So RBI says, or the RBI says, I am going to take the risk for your bill of exchange. I am going to discount it, but I am going to charge a rate for that. That is known as bank rate. Now, discount or rediscounting of the bills of exchange is discontinued after the introduction of LAF. Clear? Hence, the bank rate has become inactive. So it is redundant these days. Now MSF assumes the role of bank rate. That is if it is to be done at a higher rate, then it is going to be marginal standing facility. That is, in case of emergency, you need the funds and you keep your discount, bills of exchange, then the MSF will be charged. Right? If in the normal case, it can be repo rate. Currently, the bank rate acts simply as the signaling rate, and the most interest rates are delinked from the bank rate. The bank rate is used only for calculating the penalty on default in maintaining the CRR and SLR. That is the only role of bank rate, that it is used to calculate what is the penalty if the commercial banks do not maintain the CRR or the SLR with the central bank. For calculating the penalty only the bank rate is being used. Otherwise, the bank rate is now redundant. Clear? Okay, so with this, the direct and the indirect controls are over. All the monetary policy instruments that were to be discussed, we have already discussed all the instruments now, right? So guys, please do share these videos with all your friends. I hope this is the complete coverage. You just have to invest in the handbooks, nothing else. So please do share with all your friends. That is a small contribution that you can do towards your KSJ family, as we are putting in so much efforts. We are providing everything on here YouTube. So I expect that much from you guys, right? I hope you will do the needful very soon, and you will share on all the platforms with your friends, on your social networks, wherever you can, right? WhatsApp groups or whatever the groups you have, please do share. Okay, so the next one is the Monetary Policy Framework Agreement. Now, what is this Monetary Policy MPFA? What is this Monetary Policy Framework Agreement? Let's try to understand. He says MPFA refers to the agreement between the Government of India and RBI on the maximum tolerable inflation rate. So they what they have done is, the Government of India and the RBI has done a memorandum of understanding. Basically, it is not understanding, basically an agreement, right? That what is the maximum inflation rate that a country can tolerate, that is acceptable, we can say. It is the rate that the RBI should target to achieve the price stability, that beyond this, the prices will not be stable, right? So this is the maximum tolerable inflation rate. The inflation targeting is the announcement of the official target range for inflation. See, inflation can be measured in the numerical forms, as I told you earlier also. In the numbers, we can identify the inflation. That is what the targets are set, that this is the minimum and the maximum range of inflation, right? Why minimum is required, sir? Because if the rate is going beyond the minimum, then that means the economy is going into recession, right? And if this rate goes beyond the maximum tolerable rate, that means the economy is going into high inflation. So the expert committee under Urjit Patel suggested that the RBI should make the inflation targeting the main objective of the monetary policy. And in the monetary policy also, we studied about when we were discussing about the objectives of monetary policy. There I told you that one of the major objective is the price stability. Why the price stability was one of the major objectives? For the inflation and recession purposes, right? So inflation target should be set once in every 5 years. The RBI has to publish the monetary policy report in every 6 months to explain the sources and the forecast of inflation for the next 6 to 18 months. So every 6 months they have to meet, the RBI has to publish the report that what is going to be the forecast for the inflation for the next 6 to 18 months. As per the government, the failure to attain the inflation target refers to if the average inflation is more than the upper tolerance limit for any 3 consecutive quarters. If the average inflation rate is higher than what the rate was set, the tolerable rate was set, if it is higher than that, then we say that the failure to attain the target, right? Then if the average inflation is lower than the if it is less than the lower tolerance limit for 3 consecutive quarters, then we say the economy is going into recession, sir, right? The economy is going into recession. Even then it is a failure on the part of the government, on the part of RBI and the government for achieving the inflation targets, right? So after that, it is the Monetary Policy Committee, that this Monetary Policy Framework Agreement, and it is being governed by the Monetary Policy Committee, who is regulating all these inflation targets, right? So Monetary Policy Committee is the body of the RBI, headed by the governor, responsible for taking the important monetary policy decisions about setting the repo rate, right? So all these decisions, the monetary policy decisions, are taken by the MPC, that is the Monetary Policy Committee. The MPC was set up after a memorandum of understanding between the government and the RBI about the conduct of the new inflation targeting monetary policy framework in February 2015, that for the implementation of this, right? So this was again formed. There was a memorandum of understanding between the government and the RBI. The main responsibility of the MPC is to administer the inflation targeting monetary policy regime through determining the policy rate or the repo rate to control the inflation, right? So we have already discussed about repo rate, reverse repo rate, what all is aimed at: controlling the money supply, controlling the inflation, and controlling the money demand, right? So that is all the main purpose here is, right? So that is what the main purpose is. So structure of MPC, that who all are the members of MPC, just go through it once, you will be able to understand, right? Nothing much to explain it, that it is formed with the 6 members, and 3 from the RBI and other 3 are appointed by the government. The members from the RBI are governor, who is the chairman, a deputy governor and 1 more officer. The government members are appointed by the center on the recommendation of a search cum selection committee, which is to be headed by the cabinet secretary. The committee is to meet at least 4 times a year. That means every quarter they will have to meet and review. That is why we here say that every quarter it is being reviewed, right? And make public a decision following each meeting. There will be no reappointment of the committee under the MPC. The governor has the casting vote and does not enjoy the veto power, exclusive power, doesn't enjoy it. The decisions will be taken on the basis of the majority vote, right? So what are the functions of the MPC? The main responsibility of the MPC will be to keep the inflation target set by the RBI. The MPC decides the changes to be made to the repo rate to contain the inflation within the target level set under the India's inflation targeting regime. Right, so the members of the MPC can suggest the reasons for their support or opposition for a policy rate change. This will be published in the minutes, and the minutes are to be published after 14 days of the MPC meeting. Journal things. These are absolutely journal things which you have to just go through. But yes, keep in mind, because in the examination you can be asked for a short note on the Monetary Policy Committee. Right, you can be asked a short note. In that case, you have to tell what is MPC, what is the composition of MPC in short you have to give, then what are the major functions of the MPC. Basically, the whole of this thing is revolving around what? Is revolving around the control of inflation. How can you control inflation? When there is inflation, sir, inflation is when there is excess money supply in the economy. Right, so the basic purpose is you have to control the money supply, you have to reduce the money supply so that you are able to reduce the demand. Money demand is reduced, and when the money demand is reduced, obviously the rate will come down, the inflation will come down, right? So this is all about this chapter of monetary policy. We are done with this particular chapter, and this unit, this money demand, money supply, monetary policy, everything is done. So we are done with that 9th chapter also. Now we are starting with the next unit, which is again very, very important. That is international trade. International trade, again a very important part, right? Very, very, very important part. 5 chapters we have. The theories of international trade are there, exchange rate is there. Some of the things are very easy to understand, right? But we'll try to cover it as soon as possible, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.